intangible asset in the group accounts. But the individual company, the subsidiary company, does not recognise its own goodwill and its own brand. So the third way that we can account for and come across intangible assets, you can buy them, you can develop them. The third thing that you can do with them is part of a business combination. As part of a business combination. As part of a business combination. i.e., in the group accounts, intangible assets can be recognized as a fair value adjustment if they have a reliable measure. If they have a reliable measure. So the initial recognition would be a fair value. The initial recognition would be a fair value. So in the group accounts, we would have an intangible asset can be recognized as a fair value adjustment if they have a reliable measure. Therefore, the brand and the goodwill of the sub can, stroke does appear in the group accounts but not the individual accounts. And I just need to let that settle for a moment. I just need to recap and repeat everything that I have just said. International Accounting Standard 38 deals with intangible assets. The brand, the goodwill of the sub can, the brand and the goodwill of the sub does appear in the group accounts, but not the individual accounts. Yeah? So that's a little bit weird, isn't it? Yeah? Nike as a sub, Nike as a company doesn't have its own goodwill and doesn't have its own brand appearing in its balance sheet. But if Nike were taken over, then on acquisition, there would be a fair value exercise on the subsidiary's assets, and one of those assets, if it has a reliable measure, would be the brand name, and then you'd have also the goodwill. If you can't recognise the brand as a separable asset, it ends up being subsumed within the goodwill figure. So, let me repeat from the beginning. An intangible asset is an identifiable, non-monetary asset. Identifiable, separable, contractual. Control, yeah, it's an asset, so we must control it and have economic benefit. We can buy it. Buy it from the government, buy it from a competitor, buy it from an inventor. We can buy it. Credit, cash, debit, asset, very simple. We can make our own. Anything to do with research, market research, expect. Development implies prototype. Development implies finishing. Development implies that we have a specific project that we're about to launch and we're just kind of redesigning it. We're just kind of getting it right and ready for market. And if it is a separate project where the expenditure is identifiable, if it's commercially viable, technically feasible, overall is going to be beneficial, whether by profit or cost saving, and we've got the resources to complete, in those circumstances we capitalise it as an intangible asset. You cannot recognise your own brand, you cannot recognise your own goodwill, you cannot recognise your own customer list or stuff like that. But if you are buying a sub, then as a fair value exercise, you do recognise effectively the intangible assets of the sub, even if the sub doesn't recognise its own intangible assets. All we've done is now recognise the asset. Subsequent accounting. Subsequent accounting. Once we've got an intangible asset in our books, there are two ways of accounting for it, either cost or fair value. To be blunt though, it's always at cost. You would only be able to revalue an intangible asset if there was a readily ascertainable market value. There's only one brand name called Nike. So even if you bought the brand name of Nike in a business combination or in a separate purchase, you'd never be able to revalue it because there is only one brand name of Nike. So most intangible assets are unique. There's only one product. I suppose the rare example might be taxi licenses or fishing licenses. But to all intensive purposes, this is an academic point. If it was at fair value, it would be fair value through OCI. Yeah, so you would take the gain. You wouldn't take the gain or loss to P&L. You take it to OCI. But basically, you're going to have it at cost. Subsequent accounting, indefinite or finite life. Indefinite or finite life. If you buy a fishing license for 10 years, if you buy a license to drill for oil for 10 years, then it has a finite life of 10 years, and you would systematically write it off over that predetermined period. So some intangible, if the patent runs out, yeah, if copyright runs out, software will have a limited life. It's a judgment, but you know how rapidly things change, so you're going to have to, yeah, systematically write that off over its useful life. If it has a finite life, then you have a systematic amortization. You have a systematic amortization. I don't know exactly when Coca-Cola was invented, marketed. But there are certain brands, like Coca-Cola, or there are certain intangible assets, like Coca-Cola, like, I don't know, Coleman's mustard, or Tiger Balm, yeah, which are continually advertised, Walt Disney, which are continually marketed. And therefore, I think it would be wrong to say all intangible assets should be systematically written off over a predetermined period, because if the intangible asset is supported by advertising, is supported by continued marketing, in theory, it does have an indefinite life. Not an infinite life, but an indefinite life so long as it is continued to be marketed. So if something is established and you're going to continue to support it, the argument is that the intangible asset could have an indefinite life. If it has an indefinite life, then you should conduct an annual impairment review. You should conduct an annual impairment review. Right, that is my, for want of a better word, story on intangible assets. So there's a certain amount of knowledge that you need to have there. Let's see a past examination question so that you can appreciate, before revision, how this sort of topic does get examined. Now, the past examination question I'd like you to have a look at is on page 133. Two minutes. Please, can you find page 133? And please, could you give it a cursory, preliminary read?